Hello, everybody. This is the Procopio webinar on early stage financings. We're going to talk about financing an early stage company from formation all the way through a Series A financing, including some of the nuances that happen along the way between founders, friends and family investors, accredited investors, seed investors, and then venture capital investors who are usually participating in the Series A financing. So I'm Mike Kinkelaar. I'm a corporate partner here at Procopio, Corey, Hargreaves, and Savage. I've been a corporate partner here for 42 years. Actually, my undergrad's in finance from University of Illinois, and I went to Hastings Law School up in San Francisco. I was a tax lawyer when I began, and I switched over and became a corporate lawyer. But my 5 years of tax law actually aided me a lot in corporate financing and structuring capital raises and things like that for companies. And because I've been around that long time period, I've been through the 2000 dot-com bubble, the 2008 recession, and the post-COVID market value drop in many market valuations around the world, including public companies, private companies, and early stage venture financing. So I've seen a few down rounds, let's say that, for those of you who are familiar with what those are. Many of you are probably early stage, maybe even some of you haven't formed your company yet, but I'm going to start with sort of the basics of ground zero. A couple people want to start a company. They have to choose an entity, which is very important when you're raising money, and I'll explain why. I would say the gold standard that I recommend for everybody now is a Delaware C corporation, and there are a variety of reasons for that. Delaware has built its laws over the last 200 years to be very company favorable. A lot of litigation has happened in Delaware, so there's a lot of court cases in Delaware. You kind of know the law in Delaware. It's very business friendly. In fact, the recent changes the Delaware Assembly made recently are actually to try to make it more company favorable and less favorable for people who are trying to file lawsuits against boards of directors and corporate boards and control people in Delaware, because they know that they generate a lot of business from companies forming in Delaware. Most companies that go public, if they're not already a Delaware corporation, they convert into Delaware for a lot of different reasons, not the least of which it's easy to do business in Delaware, and Delaware laws are very understandable. Most of the lawyers that you will deal with that represent venture funds or represent investors, sophisticated investors, all understand Delaware law. They understand how Delaware corporations work. It's a very secure, jurisdiction to form a company in. A lot of people are freaked out about California, maybe unnecessarily, but they just feel strange if you say you're a California corporation. You can still do deals, but they feel much more comfortable for Delaware. And especially if you're an LLC, I would certainly suggest that you convert into a Delaware C corporation. You can actually convert into a Delaware C corporation and be an S corporation at the beginning when you just have 2 or 3 people. If you have cash in the business and you need to get that money back. So there's some flow through advantages to being an S early stage, just like an LLC. So there's no reason why you wouldn't do it that way, even if you want some tax benefits from your tax basis for cash that you might have put into your entity in the early stages. LLCs, by the way, are very good for real estate investments and things like that. But for technology companies, most of our clients are tech companies, hardware, software, artificial intelligence, all kinds of technology. And there's a reason why Delaware law is very favorable. There's a reason why C corporations are very beneficial to use as a starting point for raising money. So many times, unless somebody's already a Delaware C corporation, I will help them convert their entity into a Delaware C corporation. And then I've never had a lawyer on the other side of any deal say, "Why are you a Delaware corporation?" Although I've had many people say, "Why are you guys at Wyoming or Nevada or sometimes even California?" So that's sort of a starting point, choice of entity. Now you're starting the initial capitalization of the company. The 2 or 3 of you get together and start the company. The founders authorize 20 million shares of common stock, par value in Delaware. And I typically grant 10 million shares, half of the authorized shares, to the founders. If it's 2, 5 million each. If it's 3, 3.3 million each. 4, 2.5 million each, something like that. Most of the time when people form a corporation, as you know, they don't put money in, if maybe a little bit, but not much. They contribute their intellectual property, their ideas, their inventions, all the business that they have, everything they've done to date. They contribute that in exchange for their stock. Typically, many times, what I often do is I say that half of the shares they get are vested and the other half are restricted stock. Because, and I've seen this happen many times, I recommend vesting at least maybe half or even a percentage, maybe a third, but usually half of their founder stock, is because if you have three founders and one of the founders flakes out and he goes to Brazil and he is non-communicative, he doesn't cooperate anymore, the other two guys who are left, the other people who are left holding the bag, don't want him to have all the shares. So in a restricted stock situation, you can buy back the invested shares, and therefore the people that stick around and follow through with the next couple years don't feel cheated because they gave all the stock in a vested format to one of the founders. By the way, restricted stock, as some of you may know, it's very tax advantageous to do that. You just file an 83B election within 30 days of the date you get your restricted stock, and you can basically declare that it's worth a penny or something along those lines when you have to include that number of shares in your tax return in the year in which you get the restricted stock. So it's a very tax advantageous way to get stock to usually early stage founders, sometimes even new CEOs that come in want restricted stock. So there's ways to do that to get the stock structure set up. Just a sort of a side note, if it's a 50-50 company where there's two people and so they want to own 50%, that's sort of a recipe for disaster. So I typically recommend that they enter into a shareholders agreement that deals with a death, disability, divorce, bankruptcy, to tell the two founders what happens in the event of those four things, so that somebody doesn't end up with a shareholder that they don't want to be a partner with, like somebody's ex-spouse or somebody who buys shares out of bankruptcy. So if it's a 50-50 deal, I typically recommend shareholders agreements, buy-sell agreements. Some people call those buy-sell agreements, but most good corporate lawyers know what those entail. They're very wise to do it. Usually, if you have one of those, it never happens. If you don't have one of those, bad things happen, and you wish you had a shareholders agreement in the beginning. For founders, obviously, startup funding, oftentimes the founders put in a little seed money just to pay the lawyers or to get certain things done, $2,500, $5,000, or whatever it is. Usually we consider that part of the contribution into the company in exchange for their initial founder shares. And let's say you put in that initial money and you need some other things to be done, and you don't really want to put in that money as capital. You could actually make a loan to the company. Let's say you need another $10,000 or $15,000. You can put that in as a promissory note, just a straight loan that gets paid back when you get funded. That's another way of sort of getting some money into the company, getting your initial capital going, so you have to pay your initial bills. Now, the next stage usually is friends and family. You need $100,000, $200,000, $50,000. How do you get that money in the door when your brother-in-law or your mother or your father or your sister wants to invest in your company? Typically, you don't want to issue common stock to early stage investors, even friends and family, because you set a price. You're setting a value. That doesn't mean you can't do it. Some people will take common stock early stage, but you set a value. You've just set a value for your stock options, for example. And even though your friends and family might not care what the valuation is, it does have some ramifications later. I would oftentimes say, let's give them a safe note, or even a convertible note for that initial money. So it's not actually issuing them stock, but it's issuing them something that will convert into stock, hopefully preferred stock later on down the road. So that's why you have to be careful when you sell common stock, because the stock options that you're going to want to grant to people that are helping you later, advisors, consultants, board members, is going to be common stock. And if you set a value, you really are going to have a tough time using the exercise price at a value lower than what you sold to your friends and family in the early stages of your company. So you got to be a little careful when you do that. Things like safe notes, convertible notes are useful to not set the valuation in an early stage, but give your friends and family the benefit of getting equity later on at a good valuation. So let's say your friends and family put a little money in, and you have your first outside round. A lot of early stage companies, they come to me and they say, how much money do you think you need in the next 12 months? Because you can't spend it all at once. So they say, $250,000, $1 million. A lot of life science companies, for example, the numbers are bigger because they need a lot more money. For companies might not need so much money. So the amounts vary. So typically, when I get that answer from them, $250,000, $500,000, $1 million for the next year, I say, okay, here's what we're going to do. we're not going to sell equity for that 250, 500, or $1 million because that would set a valuation. And most people will not agree with the valuation of your company. You think it's worth a lot of money. They don't think it's worth anything, has no revenue, has no assets. It just started 3 weeks ago. Now they're not going to give you the valuation. So the way you avoid that issue, that valuation issue, is you use, in the old days, we used convertible notes. Nowadays, we use safes, and I'll explain the differences between the two. When I say old days, I mean like 5 years ago and before then. That's sort of the old days in my world because it moves pretty fast. These days, I would start with a safe offering, that is. So let's start first saying that you wanted to do a convertible note offering. Let me explain a little bit about that. The nice thing about raising money using convertible notes is it's very simple. The investor sort of likes it because it's actually debt. So if you go out of business, they are a creditor of the company ahead of any equity holders. So they're going to get their money back first before any shareholder or equity holder gets any money at all. So they like that. So in a way, it's sort of a built-in liquidation preference, if you will, because it's a debt instrument. It does pay interest. Convertible notes typically pay interest, usually between 6 and 8%, are typical market numbers these days. They convert into preferred stock, not common stock, but preferred stock. And the reason we do that is you want to give them the benefit of all of the rights, preferences, and privileges of a preferred stockholder that invests later on down the road, whether you raise $1 million or 2 or 3 or 4. You want to give them the exact same type of security. So that's an incentive for them to put money in the company because they know when this convertible note converts, principal plus accrued interest, it's going to convert into preferred stock. That's a great thing because the later investor who negotiates all these liquidation preferences and protective provisions, they do all the hard work. And your early stage investor gets the benefit of that hard work because their note is going to convert into preferred stock later on down the road, except they get an added benefit and they get the preferred stock at a better price than the later investor. And that's because you say in the convertible note that the note will convert at the lower, and some people use one or the other. I use both. The lower of a discount, the market is typically 20%, or B, pre-money valuation. Really, it's called a valuation cap. It's not pre-money valuation. It's a valuation cap. Now, that's not a pre-money valuation, but investors think of it as being a valuation. So let's say you want to raise $500,000. You do a convertible note, 8% interest. The other thing is notes have a term. It may be a 3-year note, a 2-year note, a 4-year note, a 5-year note. If you do notes, 3 years is most common. I would say 3-year note that carries an 8% interest, and it converts in on a qualified financing. And that's always a defined term in the note. And the qualified financing is defined in a note. It's the same for a safe, which we'll talk about later, is as the first equity offering of preferred stock that the company enters into after the date of the note, which raises at least X. And usually, if I want to convert the notes, I set the bar low, like at $1 million. Later on down, when you do future safe financings or note financing, you might want to set the number at 2 million or 3 million, which is you have to raise at least 1 million, 2 million, or 3 million in preferred stock before the convertible note automatically converts into that same kind of preferred stock, but at the lower price, the lower of the discount or the valuation cap. So that's sort of how those convertible notes work. The nice thing is typically there's 3 documents. There's a term sheet that sets out the terms of the note. There's a subscription agreement that makes the investor sign a bunch of boxes saying, I know this is an early stage company. I can lose all my money. I'm an accredited investor, this much money or over this much money. So that validates that. It sort of serves as a purchase agreement, so to speak. A lot of people, you might see other people do convertible note purchase agreements. I typically don't do that because those are a little less advantageous for the company and more advantageous for the investor because they typically have reps and warranties in there and things that in an early stage you really don't need as a company owner. You don't want to give away all that stuff early stage. And it's just a little more cost. Lawyers make a little bit more, a little more complicated to do it that way. So the way I set up my term sheets for a convertible note offering is using the term sheet, has all the terms in it. the subscription agreement that the investor must fill out. I want to invest $30,000 in this pursuant to this term sheet dated January 15th, 2025. And you check the boxes. They say, I want it held in the name of my trust. Here's my address. Here's the email address, blah, blah, blah. I understand everything. They sign it. They send that in. And the final piece of paper that goes into the investors is the form of the convertible note. So it has the full convertible note, just has blanks for the amount and the name. So that's sort of a convertible note offering, very simple to do for an early stage company. It doesn't have a lot of money to spend on lawyers. Very simple, very easy, can be done quickly. You can stop the note offering at any time. Nice advantage of doing a note offering is, let's say you raise 100,000 and you say, gosh, our valuation cap is way too low. Maybe we ought to bump it up. So you can stop that offering. You can do a new offering for another 300,000 or 400,000 or 500,000 with a valuation cap that's higher. So you can stop and start these offerings very quickly. One thing I would suggest, though, is you only limit these offerings to accredited investors, because as securities lawyers, when we do these offerings, we must find an exemption, a federal exemption under the securities laws, where we don't have to do a public offering, basically. So the key in all these financing is find the right securities exemption. Most early stage financing exemptions, finance rule 506. 506 says that if you only take in money from accredited investors, then you don't have to do audited financial statements. You don't have to do a bunch of stuff, an inch thick of disclosures, risk factors, all that stuff that you might see in other deals. You really don't have to do that, because the law feels that accredited investors, basically richer people, and I'll explain what the rules are on accredited investors in a minute, they feel they can protect their own rights. It's not grandma and grandpa are going to lose everything they own if they lose $50,000 in your deal. And so there's a lot fewer requirements, easy to do. So I would strongly suggest when you do these financings, you take in money only from accredited investors. Just as a note is, when you're doing these financings, you all probably know this already, you need a good investor deck. That's not a scientist deck. That's not a science deck. It's not an engineering deck that you might give to engineers or scientists. It's an investor deck. One of the most important things you'll ever have to send to the investor is your investor deck, which is focused on the investor. How are they going to make money? What's your revenue model? Has certain things in there, which a lot of people have seen. You probably already have one or two or three, or you're on your sixth or seventh version of those, but that's an important piece that you put in. That's a discussion of the convertible notes. Now we're going to sort of move to what I call the current state of the art. The state of the art is simple agreement for equity, SAFEs. SAFEs were invented by Y Combinator in 2013 up in Silicon Valley, and they're very, very company friendly, and they give most all of the benefits of a note, but they're much better for tax purposes and for company purposes. And let me kind of walk you through that. The convertible note is debt, as I mentioned before. A SAFE, if it's drafted properly, is equity. The benefit of being equity, couple of benefits. One benefit is you don't have to pay interest because it's not debt. So the company doesn't have an accrued liability for interest that keeps growing month by month. Secondly, and more importantly, because it's equity and it qualifies for capital gain treatment. So if somebody invests in a SAFE and they hold the SAFE for at least 12 months, and they sell the SAFE, or they sell the stock into which the SAFE converts, after they've held it for at least 12 months, they get the lower long-term capital gain tax treatment, the lowest tax rate that we have here in the States. So that's one benefit. But a benefit that many people don't know about, that is becoming more prevalent, and even accountants don't know about this, a lot of lawyers don't know it, Section 1202 of the Internal Revenue Code. Section 1202 of the Internal Revenue Code was created by Congress years and years ago to increase investment in small companies. And over the years, it's gotten better and better. And here's how it's gotten better. They say that if a non-corporate taxpayer, which is most individuals, pension plans, whatever, not a corporation, non-corporate taxpayer, invests in a qualified small business corporation, which there's a bunch of rules, but the main rule is you're valued at less than 50 million. You have less than 50 million value. Then the investor can exclude from taxation up to 10 times the amount of their investment, up to $10 million. So a lot of private offices, when I tell them this, they say, look, I've never heard of this before. Even sophisticated investors say, I've never heard of this before. And then I send them the tax section. I say, here's how it works. They go, oh my God. So if they invest 100,000, they can exclude from taxation $1 million of gain. Wow, pretty good. They save hundreds of thousands of dollars on the exit later on down the road. Now, the one thing I have to add to that is you have to hold the equity for at least 5 years. And as you know, as a startup company, most of you aren't going to go public in 5 years. You're probably not going to get sold in 5 years. It's going to take longer than you think, even though everybody hopes you can get started and sold in 3. The reality is it's usually 5 years or more. So you sort of satisfy that requirement. But to an investor, this is a big deal, especially the more sophisticated investors. They care more about not paying tax than a lot of people, and they pay attention to these tax advantages. So the SAFE qualifies as an equity instrument where if they invest, they get to exclude from federal tax up to 10 times their investment, up to 10 million bucks. That could be a lot of money they save. So that's a sort of a sales point when I'm trying to sell to investors why they should do a SAFE, why they should invest in a SAFE versus a convertible note. It's a big deal. Now, the SAFE terms are pretty much identical to the terms of a convertible note, except for the SAFE, because it's an equity instrument, does not have a maturity date. There's no 3-year date, 2-year date, or whatever. So that's a big advantage because the SAFE just sit there and they convert just like a note would convert on a qualified financing. Or we also put in change of control provisions where they convert at a change of control. And we put in some other conversion features there, very similar to what we do with notes, so that really, even in a note situation, if you draft it right, the company never has to pay back the money in cash. Unless in a note situation, you go out of business, then the note holders do get their money back in cash because they're debt holders, credit holders. But in a SAFE situation, the people are investing because they want equity. They don't want paid back in cash. They want equity. Similar to the convertible notes, the SAFEs are converted at a qualified financing, which is defined as an equity financing of preferred stock in the company of at least $1 million, $2 million, $3 million, whatever the trigger point is. And there are reasons why you set it lower and why you set it higher. Early stage companies, I typically set it at $1 million. Later stage, mid stage, I typically set it at $3 million because you, as a company, you want those SAFEs all to convert into stock. So you clean up your cap table that way. And the investor likes it too because they get this preferred stock with all these rights at a beneficial price, better than the investors. So the conversion price is, again, a discount, just like the note, and a valuation cap, just like the note. So it's 20% discount or a valuation cap of 5 million, 7 million, 7.5, whatever it is. Now, remember, when you're a startup company and you need that first $250,000, if you really want the money in the door, you're willing to set a valuation cap lower than what you would sell the company for, or that you think the company's worth. So people come in and say, the company's worth at least $10 million. We got these great ideas. We got these patents that we filed. They're pending. Yeah, but it's going to change the world when we get these patents granted. I say, well, how much do you need the money? They go, oh my God, if we had $250,000 today, we could do this and that and the other thing, and we could do all kinds of stuff. Well, then let's set the terms of the note of the SAFE low. Same thing with the terms of a SAFE of a note, but when we're doing those SAFEs, I say, so if you need only $250,000, then maybe we really want it. And so let's give them a 30% discount and a valuation cap of $5 million, which is much lower than they think the company's worth. And it's not a valuation, it's just a valuation cap, but it gives the investor the incentive to write the check, because the investor, even though it's not a valuation, per se, they think of it as a valuation. So if they think your company is worth more than 5 million, like, oh, this company is worth twice or 3 times that much, they're more incentivized to write that check. And that's what you need them to do. You need them to write the check. So they write the check, they invest, and the SAFEs just sit there. And these things can go on for years. You raise $250 at $5 million valuation. In 6 months, you need $1 million. So you do that at a 7.5 or $10 million valuation. And you keep doing these, you ladder them up. There's no restriction on when they have to end or not. You shouldn't have 2 SAFEs with different terms running at the same time. That confuses the market. It's not good for the people that don't get the best deal. So I wouldn't recommend you do that. You close one offering out and then you start a new. So when you set out to do this, just like a convertible note, you have 3 documents. You have a term sheet that sets out the terms of the SAFE. You have a subscription agreement for the offering, for the SAFE offering, and you have a form of the SAFE. Some people, they say, Mike, you really, really, really need the money. Is there anything we can do to sweeten this deal a little bit? Because we really don't want to lower the valuation cap below 5 million, but we really need the 250 or the 500 or whatever it is. And because those are small numbers, even on the conversion, you're not getting diluted much because it's only $250,000 or 500. When you get up to raising larger amounts of money, you have to pay more attention, I would say, to the valuation cap. But they say, how can you sweeten it? Sometimes what we do is we say, okay, in addition, anybody who invests in this safe offering is going to get a warrant, a 5-year warrant. For every $5 they put into the safe, you get one warrant for one share of common stock at, we have to decide what the exercise price is, but let's say it's 25 cents a share or something like that at an early stage. At a later stage, the exercise price goes up more because these things also tie into your exercise price for your stock options later on down the road when you have your stock option plan, because the board has to take all these things into account when it sets the value of the exercise price for a stock option. So these are all interwoven, these facts, but I'm just giving you sort of the broad brush strokes of how people think about this. And I've been very successful at getting money in quickly with warrants, adding warrants on top of the safe offering, even the convertible note offering. Same. Every startup I know, after we form the company, the second thing they do is that they adopt a stock option plan, because you don't have the money, you can't pay people in cash, but you have advisors that you'd like to bring on, you have consultants you'd like to bring on, and they believe in you, so they're willing to take equity. How do you get it to them? You use stock options. And the stock option exercise price, the rule on setting the exercise price for stock options is they can't set the exercise price less than the fair market value of a share of common stock on the date the board grants the stock option, taking into account everything the board knows about the company. So that's why when you think about these safe offerings or convertible notes, you have to think about that as having an effect on your exercise price of your stock options. Let's say you've done note offerings or you've done some safes, and you've gotten to the point where the company's gotten a patent granted or 2 patents granted. You've done some things. Maybe you even have a close to an MVP, minimum viable product, and you've got some traction, you got some money in the bank, and you need a big chunk of money. Let's say you need $5 million. $5 million is probably still too small for a VC to be interested in, but it's a lot of money. So you might be looking at seed. There's some seed funds, some seed VCs, early stage seed financing guys. There's private equity or private offices, accredited investors again. And when you're talking about 5 million, you can do a safe offering. You can still do it, still works, but you might start thinking about, like some people say, I want equity. The investor says, I want equity. I don't want a safe. I don't want a note. What do you do? Typically, if you're anything less than $10 million looking to raise, you create the first class of preferred stock, not called Series A, it's called seed preferred, because most companies want to save their Series A for the big coming out party, $10 million, $20 million later on when you're worth 30 million or whatever. These days, in the old days, 10 years ago, everybody just used Series A as your first offering of preferred. But these days, most people, and it's an optics thing, it sounds better. The investor likes it. Hey, I'm getting seed stock versus Series A. And practically speaking, the terms are going to be the same as you do for a Series A, except it just sounds better. I've had people do Series A, Series 1, Series 2. So there's a lot of ways to split the baby, but usually your first offering will be seed preferred. Now, the benefit of the seed preferred is those safes and those convertible notes all convert into seed preferred. So it causes the conversion. So you clean up your cap table, then everybody has seed preferred. You got no more notes, you got no more safes. So it's an advantageous thing to do if you get the valuation right. Now, the detriment or the downside to doing an equity offering is you got to set a pre-money valuation. And there may be a lot of people out there who say, you're still not worth that much. We know you think you're worth that much, but you're not. But if you're willing to do an equity round and you come to terms with a fair pre-money value, then you can do a seed equity offering. So now we get into preferred stock. And this goes back to why we use Delaware C corporations. You cannot have 2 classes of stock in an S corporation. It's really complicated and tax complicated as heck to do an LLC when you're trying to do preferred stock or preferred equity in an LLC. So you don't want to be in that world. It's very expensive. The tax lawyers say, I don't know if that'll work, those kinds of things. But in a Delaware C corporation, I know exactly what'll work. Everybody's doing it. Most companies that you see in Silicon Valley, California, probably even New York, and the big tech centers now are using Delaware C corporations. And so everybody kind of comfortable. You don't have to argue with them about choice of law or what happens. Every lawyer knows how to do a deal with the Delaware C corporation, and it's easy to do a amended and restated certificate of incorporation that creates your preferred stock. So your seed preferred is created by doing your amended and restated certificate, laying out all the rights, preferences, and privileges of your seed preferred stock. And that's how we create the seed preferred. You do a term sheet just like you did for a note or for a safe. You do a term sheet for a set of preferred seed preferred. You set a pre-money valuation, figure out using your cap table, what's the price of each share. You do the math. The liquidation preferences and the rights and preferences are very extensive. So your term sheet for a preferred stock offering might be 6, 7, 8 pages long, whereas your term sheet for a safe or a note offering is 2 pages long. I like to be pretty specific in my term sheets for preferred stock because you don't want to be arguing with the lawyer or anybody later about something which you could have resolved up front if you would have put it in the term sheet. And so, for example, one of the biggest things in preferred stock, why investors want preferred stock, is called liquidation preference. That means they get their money back first before the other shareholders get back. So we have participating preferred and we have non-participating preferred and a couple of variations in between. Non-participating preferred basically under the liquidation preference says the investor gets to choose on a liquidity event, which could be a sale of the company. It could be a liquidation and dissolution of the company. It could also sometimes be a change of control, but however you define liquidation events, liquidity event in the amended and restated certificate, you basically give the investor the choice. They get to choose whether they want their money back or the percentage of the company that their investment represents. Hopefully that's the one they choose because that means you're worth more. And so they get to choose. That's called non-participating preferred. That's better for the company, not as good for the investor. The investor wants sort of 2 bites at the apple. They want what's called participating preferred. They want to get their money back first, the higher of. Really, that way, the way that works is they get their money back 100% first, and they get the percentage of the proceeds from the sale of the company that their investment represents. So that's a pretty good deal. Most like VCs, they'll want participating preferred. Some VCs in the old days, they want 3x, 4x, 5x. I haven't seen any of those lately. Even 2x is sort of unusual these days, but that's participating preferred liquidation preference. That's sort of a big deal in why they want preferred stock. There's some rules on when a company can pay dividends. Dividends can only be paid out of earnings and profits, and most early stage companies do not have earnings and profits for many years. So you can't even pay a dividend. So what I typically do is say that the investor will get the same dividends that the board of directors declares for the common stock on an as converted basis. Because what we know in reality is the board's never going to declare a dividend. They need all the money. They need to keep all the money to grow, to buy things, to pay bills. That's why early stage companies never pay dividends. But if you say it that way, most investors say, okay, fine. If I'm treated just like the common stockholders are, I'm fine. So you do an as and when declared or as and if declared provision for payment of dividends. Some deals ask for a percentage. More sophisticated VCs will ask for a percentage. They want 8% cumulative dividends, which means they basically get paid like it's a loan. So they make 8% on their money. So when there's a conversion or a liquidity event, they get the dividends plus at 8%, as if their investment was a debt instrument, which it's really not. But that's sort of subject to negotiation with the VC. So you'll see those in VC deals. You won't see those typically in early stage, just accredited investor deals. Sometimes in the deal, if it's a VC, they'll want redemption rights. Typically, I try not to do that. That means the company has to buy the stock back from the investor. I typically say no invention. Certainly in deals we do early stage, you never want to give a redemption right. You never want to have the investor be able to ask for their money back or that you buy them back, because a lot of times early stage companies don't have the money, or you don't want to be using your money from future investors to buy back prior investors, because the future investors won't allow you to do that, number one, and it's just bad luck. You just don't want to do that. There are conversion rights in preferred stock. That means that when there's an event that's described in the amended and restated certificate, like a sale of the company, a public offering, a change in control, there's a provision that says that the preferred stock will convert into common stock on an as converted basis. What that means is there's a provision in all of these documents called anti-dilution protection, and that might change your conversion ratio. And this is getting a little bit into the weeds, but at least when you see it, when you read a document, you'll see it goes, oh, that's what he was talking about. Conversion ratio initially is always 1-to-1. One share of preferred for one share of common, or one share of common for every share of preferred into which the preferred is converted. That's a 1-to-1. Every document will say the preferred stockholders can at any time convert their shares into common stock. No one ever does it because no one's that dumb. They don't want to get common stock. They want to keep all their rights in the preferred. So that never happens, but it's always in the document. The conversion happens on those events that I mentioned. And so let's go into how that 1-to-1 ratio changes from 1-to-1 to some different ratio. So a lot of people talk about anti-dilution. The early investors don't want the company to go and sell a bunch of stock at a penny a share and dilute the heck out of them, dilute them down as, very small amounts. To prevent that, they want anti-dilution protection, which means that if the company sells equity later at a lower price than they sold, really it's a lower valuation of the company that they bought into at, then the conversion ratio will change to reflect the math that we do to figure out how much they're actually affected. Typically, company, when you're doing an offering on the company's behalf, which is where we usually do it, we set it up, we structure it so that's fair, but not ridiculous on the side of the investor. We use broad-based anti-dilution weighted average. That's the most fair way to do it. Let's say the company raises, $100,000 at a lower valuation. You don't want every share of preferred stock converted at that lower valuation because it's really not diluted them much. Raising $100,000 really doesn't dilute them much. It dilutes them a little bit. So this broad-based weighted average formula takes into account the amount of money raised as well as the price or the lower valuation. So that's why broad-based weighted average. Full ratchet would be what I mentioned in my example. Every prior investor gets their conversion ratio changed as if the $100,000 raise at that lower valuation was used throughout all the shares, and it really screws the company because then the founders or the existing shareholders really get squashed down quite a bit. In the old days, 30 years ago, there were some people who really needed money, and the VC got full ratchet because the founders never thought it would ever happen. In the go days when every valuation is going up and up and up, said, oh, that's okay, it'll never happen. Well, in the thousands, 2008, it did happen. So thank God for those of us who had anti-dilution protection on a weighted average basis, because then it didn't kill us when we did those down rounds. A down round is basically just a round that you go out for at a lower valuation than the one in which you raised money in the prior round. Now, in anti-dilution protection, there's a very, very, very important provision under that called carve-outs. Carve-outs means that there are some situations, 5, 6, 7 situations where that should not trigger the anti-dilution calculation. Those are issuances of stock options, issuance of maybe to a landlord to buy down your rent, issued in the old days, issued to a banker to get a better loan provision. They want some of the upside. Silicon Valley Bank did that a lot of times. A lot of banks around in California did that, where they'd give you a loan if you give them some equity. And the way you did that was you give them a warrant at $1 a share. You don't want that to trigger anti-dilution. So there are a number of provisions, including buybacks that boards use to buy back stock under restricted stock agreements, things like that. So the carve-outs are important because you don't want them to trigger the anti-dilution calculation. So that's very important. The next sort of just comment is, boards of directors, when you're setting up your board, it's very important to plan ahead that the big investors in the future are going to want to sit on your board. So when you're setting up your board, think ahead. Maybe you want 3 board members, 4 board members early of friends or people that are loyal to you, because you're going to have to give away 1 board seat, maybe even 2 later on down the road as you get bigger, as you raise more money. In preferred stock, there's another section called protective provisions, and that's to protect the investors, the preferred stockholders, from you kind of, doing something that really eviscerates the value of their stock. The protective provisions usually include, at the very least, things like the company cannot create a series of preferred stock or a class of stock that has equal or better rights than ours without our consent. And when I say our, it means a majority of the holders of preferred stock. So majority have sort of veto power. And That's only fair because they don't want you to create a class of stock that's better than theirs at a lower price or whatever, and without their consent. If you're doing well and things are going well and the valuation is going up, they'll always consent if it makes sense for the company. So that's a protective provision. There's other protective provisions that can be, you can't change your bylaws without their consent. A majority of the preferred stockholders, there are a number of things that they don't want you to do, which affects their valuation. So those are called protective provisions. When you're setting it up for yourselves, when you're doing an offering, you typically put in the minimum protective provisions to protect them from being treated unfairly, but you don't want to add a bunch of other things that they don't really need. Those are protective provisions, and they're very important, and they're in every really good set of amended and restated set of a certificate that has the creation of preferred stock. When you get preferred stock, if they're sophisticated investors, sometimes they want information rights. In other words, they want the right to get financial statements, quarterly, annual. You may not have audited, but at least you want to have the same set of financials, quarterly and annual, that the board gets. So they want information rights. That's usually in an information rights agreement. That's sort of a separate document that goes along with a preferred stock offering. And that's fine. You don't mind giving it to them. You don't want them digging around and micromanaging the company, but that's something which, if they're bigger investors, they're going to demand that anyway. So you might as well give it to them. Another thing that goes in that agreement, that side agreement, and sometimes the agreement is called a registration rights agreement, are registration rights. What does that mean? That means they have the right, if you go public, to make sure that you register their shares so that they have liquid shares on the public markets. And those are registration rights. Hopefully you'll have to deal with these because that means you're going public. So those are things that they have demand registration rights. That means they can demand it under certain situations. And there's also S1 rights, which you may have to register their group separately from when you go public or you do your S1. Another thing that oftentimes when you get to do deals with VCs, this will be an agreement they send you. It'll be a 45-page agreement that has things like this in it. It'll also have participation rights, so they can participate in future offerings that the company does, pro rata usually. If they don't want to be shut out of future financing, so if it's a VC, they always put these in here. They also have drag along rights, which means if a majority of the company and the board approve a deal like a sale, everybody who signs that agreement has to agree to the sale or the transactions. Those are drag along rights. The rationale for that is they do not want small shareholders holding up a big deal that may be and maybe it's a great deal. And there's some people who just won't sign a document. They won't respond. They are obstructionists or whatever. So they put drag along rights in these agreements to make sure they don't have to deal with these small people that hold out for whatever reason. Because their goal, remember, when they put the money in, is to get their money back at 5x, 6x, whatever they hopefully can get. They want to get their money out. So getting out is as important as getting in. To the more sophisticated investor, the more important this is. The other kinds of rights that are in these agreements are right of first refusal, which means, obviously, if somebody offers a shareholder $100,000 for your 20 shares, the company has the right to match that offer, and the company has the right to assign that buyback right to any other major shareholders in the company, including the VC, private equity group, or the private office or whatever. So those are typical rights. You'll see those in every registration rights or shareholders, investors. Most of the times I think they would call these investor rights agreements. And these are things that you'll see if you ever do a VC deal or a bigger company deal. Typically, we don't offer that when we're just doing a seed preferred offering, because most people who invest in seed offerings are not VCs. They're rich people, accredited investors, maybe a private office or two, maybe even some seed financing people who might ask for this, and that's fine. But we don't give it away if we don't need to. So we typically don't offer an investor rights agreement when we're doing a seed offering of, let's say, $5 million. If somebody asks for it and they demand it, they're willing to put $3 million in, sure, we'll do a deal with them. We'll enter into an agreement like that. Another provision is strategic financing. That's a big dog in your industry wants to invest in your small company because they want the rights to some of your IP. They want first rights to buy you. That's a strategic investor. The advantage of a strategic investment is that the investor, the big dog investor in your industry, they don't care so much about the valuation. So they'll give you the great valuation, but they want all the other rights, like the right of first refusal, the first right to buy you, and certain things like that. Now, a strategic investor can be a detriment because it could cause other investors, other strategic investors in the industry not to invest in you because they say, hey, Glaxo has a strategic investment in you, and so they're going to get all the rights, and we don't want to bid against Glaxo, so we're not going to invest in you. So it may cause other investors to shy away from you. So there's a downside to a strategic investment. You have to sort of analyze those on an ad hoc basis as they come. Sometimes they're good, sometimes they're bad. Sometimes you can negotiate terms that are fair and it works really well for you, and it's all in the negotiation. So the devil's in the details in that situation. And then finally, the kind of investment that a lot of you may get is government grants, SBIR phase 1, phase 2 round. But government grants are great because typically they don't ask for stock, they don't ask for equity, they don't get any rights other than they get the right to use it for government purposes. You got to negotiate those rights carefully, but it's non-dilutive. The other shareholders aren't diluted. Many shareholders love it when their companies get government grant, SBIR money, because you don't have to go out and raise money from private investors. You don't get diluted. It's a great way to keep the company going. You could be doing a safe offering and give government grants at the same time. So it adds to the cash that the company has, and it adds to your credibility. If you get an SBIR grant, that sort of shows the investor that, hey, you guys must be doing something right. The government believes you're doing something that's worth, a government grant. So that's good stuff. So we're about at the end point. Hopefully you have gotten a little bit of an idea, soup to nuts, how it works from startup to Series A or seed financing. Series A really is just the next version of what I explained in a seed financing when you use preferred stock. Same rules, same liquidation preferences, anti-dilution protection. It's all the same, except in a Series A, you're probably going to be negotiating your Series A, most likely with a VC, and then it's all negotiable. Hopefully this has been informative. And good luck to all you out there who are going to be raising money. Thank you.